All right, so the new Income Tax Act 2025 is here, and let's be honest, one of the most critical areas for professionals like us to get right is the clubbing of income. These anti-avoidance measures, now neatly packed into Chapter V, can easily trip you up. That's why in this explainer, we're going to break it all down, piece by piece.
Here's a question I'm sure you've heard a dozen times. Hey, can I just move some of my income over to my spouse to drop into a lower tax bracket? It's definitely a tempting thought, right? But the short answer is, well, it's not quite that simple. The Income Tax Act has a very specific and very robust set of rules designed to prevent exactly that.
And that brings us right to the heart of what we're talking about today, the clubbing of income. What is it? Well, it's the legal tool that lets the tax department take the income earned by someone else, say your spouse or your child, and pull it right back into your total income for the tax calculation. Basically, it's the government's way of saying, nice try, but you can't just shift money around on paper to dodge taxes.
So, here's our game plan. We'll start by understanding the why behind these rules. Then, we'll dive deep into how this works for a spouse's income and then for other family members and minors. After that, we'll look at the enforcement side, how the tax liability actually gets collected, and we'll wrap it all up with some key takeaways you can use in your practice right away. Okay, so let's start with the fundamentals. Why do these clubbing provisions, this whole Chapter V, even exist in the new Act? What's the core idea?
The entire principle boils down to one simple phrase: substance over form. Look, the tax department doesn't really care whose bank account the money ended up in. What they care about is who the true source of that income is. You can think of these provisions as a source test, designed to follow the money all the way back to its origin and make sure it's taxed in the right hands.
Now, for those of us who have lived and breathed the 1961 Act, this slide is absolutely key. It's our roadmap. What we all knew as the bulky Section 64 has now been broken down and, I think, very logically reorganized into Sections 96, 99, and 100. The fundamental concepts are the same, but the structure is just so much cleaner. It's a change we need to get comfortable with fast.
All right, let's get into our first deep dive, clubbing a spouse's income. This is all covered under Section 99(1)(a), and it's probably the situation you're going to come across most often.
When you look at Section 99(1)(a), it really boils down to two key scenarios. The first is about remuneration. We're talking salary, commissions, fees, you name it, paid to your spouse from a business where you hold what's called a substantial interest. The second scenario, and this is a big one, covers any income your spouse gets from assets you've transferred to them without adequate consideration.
So what exactly is this substantial interest that triggers the first scenario? It's not some vague concept. The Act is super specific. It means you, either by yourself or with your relatives, hold a certain percentage of the voting power or are entitled to a specific share of the profits. You have to check the thresholds.
Let's just walk through the chain of events here. Step 1, you have a substantial interest in a company. Step 2, your spouse gets paid by that same company. But then comes Step 3, and this is the real kicker. If that payment isn't genuinely for your spouse's professional skills or technical qualifications, then, boom, Step 4, that income gets clubbed with yours.
And this quote, pulled straight from the new Act, is the get-out-of-jail-free card, so to speak. The law is very clear. If your spouse is a qualified professional and is earning that money because they have the actual skills and experience for the job, then that income is theirs to keep and it won't be clubbed. But remember, the burden of proving that is always, always on the taxpayer.
Okay, on to that second scenario, covered in Section 99(11)(a)(ii), income from assets you've transferred. The rule here is really straightforward. If you gift an asset, maybe a rental property or some stocks, to your spouse, any income that asset generates in the future, like rent or dividends, gets taxed in your hands, not theirs.
Now, there are a few critical points here. First, the law is smart. It covers both direct and indirect transfers, so you can't just use a middleman to get around it. Second, that term adequate consideration is key. It means a fair, market value price has to be paid. And finally, there's one important exception. These rules don't kick in if the transfer is part of a formal agreement for the couple to live apart.
So we've covered spouses, but what about the rest of the family? The logic stays pretty much the same, but the rules also extend to your daughter-in-law and, of course, to the income of your minor children.
You know that logic we just talked about for a spouse? Well, it's pretty much the same deal for transfers to your daughter-in-law. Section 99(1)(b) makes it clear. If you transfer an asset to your son's wife without getting adequate consideration, any income that asset produces gets clubbed right back into your total income. It's a very specific provision to close a potential loophole.
Now, for a minor's income, the rule is really broad. Generally speaking, pretty much all of a minor's income is clubbed with the income of whichever parent is earning more. This is for things like interest on a fixed deposit you open in their name. But just like with the spouse's salary, there's a big exception. Any money the minor earns through their own work, talent, or specialized skill is not clubbed. That income is theirs.
And holding all of these rules together is the bedrock principle you'll find in Section 96. Think of it as the ultimate safety net for the tax department. It basically says you can't try to be clever by transferring just the income stream from an asset without actually transferring the asset itself. If you retain ownership, you retain the tax liability on its income. Simple as that.
Okay, so we know when income gets clubbed. The rules are clear. But how does the government actually get the money? What's the enforcement mechanism? That's where Section 100 comes into play.
And this is where things get really interesting. Even though the income is clubbed and added to the transferor's tax calculation, Section 100 gives the assessing officer a powerful tool. They can actually recover the portion of tax related to that clubbed income directly from the transferee, the person who actually received the asset or the money.
Let's just put a number on that to make it real. Imagine the clubbed income added an extra 25,000 rupees of tax to the transferor's bill. Well, the tax department can send a notice directly to the transferee, the spouse or child who holds the asset, and demand they pay that $25,000. So what does Section 100 really let them do? Well, for starters, they can serve a notice directly on the person who's holding the asset. If it's held jointly, everyone is on the hook. And once that notice goes out, the full force of the normal tax recovery rules can be brought against that person. It's serious business.
So, let's wrap this up by bringing it all back to what matters most for us in our day-to-day practice, the key compliance takeaways. What do we need to be doing differently now?
Think of this as your new checklist. First, always look past the paperwork to the real substance of the deal. Second, if an asset is being transferred, you need ironclad proof that the consideration was adequate. Third, if a spouse is getting paid, document their qualifications. I'm talking CV, job description, proof of work, the whole 9 yards. Fourth, for minors, keep their earned income and gifted income totally separate. And finally, please advise both parties in a transfer about Section 100. Nobody likes a surprise tax notice.
At the end of the day, the big message from this new chapter is crystal clear. Substance will always win over form. And that leaves all of us with a critical question we need to ask about every strategy we advise on. Is it genuinely robust, or does it just look good on paper? Thank you for watching. If you found this explainer helpful, please like, subscribe, and share it with your colleagues. And a quick reminder, this video is for educational purposes only. Tax laws are complex and subject to change, so please consult with a qualified professional before taking any action.